Comparing Bitcoin and traditional banking involves understanding their key differences in terms of structure, function, and underlying principles. Here's a comparative study. 1. Structure. Bitcoin. Bitcoin operates on a decentralized network of nodes and miners, with no central authority or intermediary controlling the network. Transactions are recorded on a public ledger called the blockchain, which is maintained and validated by network participants. Traditional banking. Traditional banking operates within a centralized system, where financial institutions such as banks and central banks serve as intermediaries for financial transactions. Banks maintain centralized ledgers of account balances and process transactions on behalf of their customers. 2. Ownership and control. Bitcoin. Bitcoin users have full ownership and control of their funds, with private keys serving as proof of ownership. Users can transact directly with one another without the need for third-party intermediaries, providing financial sovereignty and autonomy. Traditional banking. In traditional banking, customers entrust financial institutions with custody of their funds, relying on banks to store, manage, and transfer their money. Banks have control over account balances and transactions, with customers accessing their funds through bank accounts and payment systems. 3. Transparency and privacy. Bitcoin. Bitcoin transactions are transparent and recorded on the blockchain, allowing anyone to view transaction history and account balances. While transactions are pseudonymous, with addresses representing wallet identities, they are not inherently linked to real-world identities. Traditional banking. Traditional banking transactions are private and confidential, with banks obligated to protect customer information and financial data. However, banks may disclose customer information to authorities for regulatory compliance or legal purposes. 4. Accessibility and inclusion. Bitcoin. Bitcoin offers financial inclusion to individuals who may not have access to traditional banking services, such as those in underbanked or unbanked regions. Anyone with internet access can participate in the Bitcoin network and transact globally. Traditional banking. Traditional banking services require individuals to meet certain eligibility criteria, such as identification documents, credit history, and residency status. Access to banking services may be limited in remote or underserved areas, contributing to financial exclusion. 5. Security and trust. Bitcoin. Bitcoin security is based on cryptographic principles and decentralized consensus mechanisms, making it resistant to censorship, fraud, and unauthorized access. However, users are responsible for safeguarding their private keys to prevent theft or loss of funds. Traditional banking. Traditional banks implement security measures to protect customer accounts and transactions, such as encryption, authentication protocols, and fraud detection systems. Customers rely on banks to uphold trust and maintain the security of their funds. Ultimately, Bitcoin and traditional banking represent contrasting approaches to finance, with Bitcoin offering decentralized and borderless peer-to-peer transactions, while traditional banking provides centralized financial services with regulatory oversight and consumer protections. Both systems have their advantages and limitations, catering to different needs and preferences within the broader financial ecosystem.